Victor, do you agree? Is this time to buy?
Not quite yet. You know, we've just seen two shoes drop so far. We've had the coronavirus, we've had the oil price shock, and there may be a few more shoes to kind of drop. So yeah, look, there's been a sell-off. High yield spreads have gone out from 300 odd to 650 basis points to treasuries. But in the overall scheme of things, we think over the next month, the next 6 weeks, there's even a lot more downside to come.
What are you seeing in your actual existing investments? I mean, are you seeing in some of the companies that you work with some distress, or is there some independence from what we're seeing?
You know, the kind of sell-off we are just in the process of having, it is broad brush. Valuations are just coming down all across. So whatever you thought, if you thought something was worth 100 cents, if something was worth $100 like 2 weeks ago, the equity markets are telling you it's worth $80 today.
All right. Well, it's not just Howard Marks, right? Yeah. And you are saying, that potentially could become a buying opportunity. And Stephen Schwartzman of Blackstone said, from an economic perspective, the virus has created dislocation in the market and fear among the people. It creates a substantial opportunity to buy assets and give credit to Howard Marks's point. And you were saying there will be a buying opportunity. How do you know when that's come?
Yeah, you know, none of us knows where the bottom is, Lisa, right? But can I give you a framework? Would it help?
Please. Yeah?
So let's say a private equity fund buys a company for $150 and they put $100 of debt on it. Now, the company now is worth $110, $120 instead of $150. As a distressed debt investor, we are looking for a big cushion. So this debt might have been trading at 90 cents, 95 cents before. Now, when it gets to 65 cents or 70 cents, we have that big cushion, right? We can take a lot more stress when you buy at 65, 70 cents. So I think when you think about distressed investing, our view, you have to think about it very differently than equity investing. In equity investing, you don't have the cushion. In our world, we are in a market now where we don't have to do an Excel spreadsheet and calculate exactly what our IRR is, right? When you get down to that 65, 70 cent level, you start buying, and if it becomes 50, 55, you buy more, right? So I think we think about it, distressed, very different than equities.
We're seeing certainly distress in the United States. We're seeing a sell-off here. Yeah. Over in Europe, there also is a similar market move, although perhaps buffered a bit by the ECB.
It's much bigger.
It's bigger.
Oh my gosh, it's bigger.
The opportunity or the sell-off?
Yeah, the sell-off too. Like in equity markets have sold off more than the US.
What about with respect to the opportunity?
Europe had $1 trillion in non-performing loans before all this coronavirus recession fear started. Europe had Germany, France, and Italy struggling, just trying to get through without going through a recession. So what's happened now? We think there's a recession in Europe now. You're going to see negative GDP prints coming out of all these countries, right? So the European opportunity, which was always big to start with, has just gotten much, much bigger than the United States.
So what kinds of investments are you targeting?
We like these old economy businesses. We like businesses with a lot of hard assets. And by the way, we like businesses in Northern Europe. We like them in Germany and the UK. Not so much in Italy, not so much in Greece, right? So, and in that world, so look, Europe is much more a mid-market world. It's much more private debt. It's much more smaller deals, not kind of the name brand deals which get distressed in the US like American Airlines or like AMC Cinemas, right? It's just a whole different group of kind of deals. And that world, the $1 billion, $500 million, $1.5 billion deal, those are the ones we are targeting.
A lot of people look at the bond market and they say there's no yields because you're seeing yields go to zero in the developed world, but there's plenty of yield if you take the risk. What kind of returns could you expect with a strategy like yours?
You know, we are looking, when you get this sort of a market move, this is already a once in 5 year crash, just what we are having, right? This is already equivalent, in our view, to 2015 with the oil and gas crash, or 2011 when the euro was going to break up, right? So in a market like this, we're looking for 20% plus IRRs in terms of the investments we're making. It's a market where capital is in short supply again. Capital married with skills. There's capital out there, but capital married with skills is in short supply, and so it is once again that moment in time.
A 20% IRR over what time period?
2, 3, 4 years.